John Kenneth Galbraith's A Short History of Financial Euphoria offers a penetrating analysis of the cyclical nature of financial bubbles that have recurred throughout history. The book highlights how speculative excesses are driven by human psychology and societal factors, leading to economic crises. Through historical examples and keen insights, Galbraith unveils the patterns of behavior that precipitate these episodes of financial euphoria. This work serves as both a cautionary tale and a guide to understanding the persistent vulnerabilities in financial systems. In the introduction to Financial Euphoria of John Kenneth Galbraith's A Short History of Financial Euphoria, the author incisively explores the recurrent cycles of speculative excess that have punctuated financial history. Galbraith elucidates the persistent human tendency toward economic optimism, which, when unchecked, leads to speculative bubbles. He underscores that these episodes are driven by a collective delusion, a steadfast belief in new economic eras where traditional rules and risk assessments are supposedly obsolete. Galbraith identifies the allure of quick wealth as a potent catalyst for financial euphoria, where rational investment practices are abandoned in favor of speculative gambles. This often results in a dramatic escalation of asset prices, only to be followed by an inevitable crash. He stresses that financial euphoria is not confined to any single era or society. It is a recurring phenomenon, evident in historical events such as the Dutch Tulip Mania, the South Sea Bubble, and the 1929 stock market crash. The author emphasizes the critical role of financial memory, how, over time, the lessons of past financial disasters are forgotten, paving the way for new generations to repeat the mistakes of their predecessors. One concrete takeaway is the necessity for vigilance and skepticism in financial markets, advocating for a recognition of the psychological components driving market behavior. Galbraith's analysis serves as a cautionary tale, urging investors and policymakers to remain wary of the intoxicating allure of financial euphoria and to implement safeguards that mitigate its damaging impact. In A Short History of Financial Euphoria, John Kenneth Galbraith's section on the historical foundations of economic bubbles delves into the recurring nature of speculative financial manias throughout history. Galbraith elucidates that economic bubbles are driven by a collective psychology that fosters irrational exuberance, leading to a disconnection between asset prices and intrinsic value. This phenomenon is fueled by the persistent belief that the circumstances driving rising prices are unique and sustainable, often dismissing historical precedents of collapse. Galbraith emphasizes that financial euphoria is rooted in a profound disregard for historical lessons. This amnesia allows speculative fervor to flourish, as investors consistently convince themselves that this time is different. He illustrates this through historical examples like the Dutch Tulip Mania of the 17th century, the South Sea Bubble of the 18th century, and the stock market crash of 1929, each demonstrating the inevitable return to reality where inflated values plummet. A critical takeaway from Galbraith's analysis is the cyclical nature of human folly in financial markets. He underscores that despite advancements in financial systems and regulations, the same psychological triggers, greed, envy, and the allure of quick wealth, perpetuate the cycle of boom and bust. His work serves as a cautionary reminder for investors and policymakers alike to maintain vigilance and skepticism, recognizing that euphoria in the financial markets is often a prelude to disaster. This historical perspective offers a robust framework for understanding and potentially mitigating future financial crises, underscoring the importance of learning from past mistakes to prevent future economic turmoil. In A Short History of Financial Euphoria, John Kenneth Galbraith dissects the recurring psychology behind speculative manias that have punctuated financial history. Central to these manias is the persistent human belief that one's own experience and insight are superior to the collective wisdom of history. Galbraith asserts that during speculative episodes, a potent mix of greed and euphoria overrides rationality, leading investors to ignore historical evidence of past financial collapses. This psychology fosters an environment where asset values are driven far beyond their intrinsic worth, fueled by the delusional conviction that this time, circumstances are different. Galbraith illustrates this through historical vignettes like the Dutch Tulip Mania and the South Sea Bubble, where the allure of quick wealth led to widespread financial ruin. These examples underscore a critical theme: the perils of unchecked optimism and the collective amnesia of past financial debacles. Galbraith's analysis reveals that such manias often end with a dramatic market correction, where reality reasserts itself and the unsustainable price levels collapse. The practical takeaway from Galbraith's work is the necessity for skepticism and historical awareness in financial markets. Investors are advised to remain vigilant against the siren call of speculative excess, and to remember that financial euphoria is inherently ephemeral. By acknowledging the psychological patterns that drive these manias, one can better navigate and mitigate the risks associated with speculative bubbles. Thus, Galbraith's insights serve as a timeless reminder of the need for prudence and historical perspective in financial decision-making. In Case Studies in Financial Folly, John Kenneth Galbraith incisively explores the repetitive nature of financial euphoria and its inevitable collapse. Galbraith argues that financial manias are driven by a cyclical pattern of speculative excess, fueled by an irrational belief that current trends will perpetuate indefinitely. He asserts that this euphoria blinds investors to the inherent risks, leading to a collective amnesia about past failures. The section illuminates this concept with historical examples that embody the folly of financial exuberance. Galbraith highlights the Dutch Tulip Mania of the 17th century, the South Sea Bubble of 1720, and the speculative frenzy preceding the Great Depression as quintessential instances where irrational exuberance led to catastrophic outcomes. Each case study underscores the allure of easy wealth and the eventual realization of unsustainable economic foundations, resulting in severe financial consequences. A key takeaway from Galbraith's analysis is the identification of common psychological and economic elements inherent in financial bubbles: the allure of novelty, the dismissal of skepticism, and the eventual panic when reality intrudes. He emphasizes the importance of historical awareness as a defense against future manias, urging investors to remain vigilant against the seductive promise of effortless prosperity. Galbraith's insights serve as a prescient reminder of the persistent vulnerabilities in financial systems, advocating for a sober understanding of market dynamics to prevent the perpetuation of financial folly. His work is a powerful tool in fostering a more informed and cautious approach to financial speculation, rooted in the lessons of history. In A Short History of Financial Euphoria, John Kenneth Galbraith elucidates the pivotal role of media and public perception in fueling financial euphoria. Central to this theme is the media's capacity to amplify speculative manias by disseminating overly optimistic narratives. The media, often captivated by rising markets, tends to spotlight success stories, thus creating a feedback loop that inflates public enthusiasm and drives further speculative investments. Galbraith stresses that the media's portrayal of financial markets as a pathway to easy riches encourages a collective amnesia regarding past financial debacles. This selective memory fosters an environment where the public, swayed by sensational headlines and expert endorsements, disregards historical precedents and inherent risks. By celebrating figures who profit from speculative gains, the media helps craft a narrative that normalizes and glamorizes financial excess. Examples from history, such as the 1929 stock market crash and the dot-com bubble, illustrate how media-fueled euphoria precedes economic downturns. These episodes demonstrate the cyclical nature of financial folly, where inflated public perceptions inevitably meet harsh economic realities. A practical takeaway from Galbraith's analysis is the critical need for skepticism and historical awareness among investors and policymakers. By understanding the media's potential to distort perceptions, stakeholders can better recognize the warning signs of unsustainable exuberance. Galbraith's insights serve as a cautionary reminder that media narratives, while influential, should not overshadow prudent financial analysis and decision-making. In A Short History of Financial Euphoria, John Kenneth Galbraith critically examines the recurrent patterns of speculative excess leading to financial euphoria and subsequent market crashes. In the section Government and Regulatory Responses, Galbraith underscores the essential role of government intervention and regulation in mitigating the destructive cycles of boom and bust. He argues that financial euphoria is often fueled by a collective delusion that markets can self-regulate, which neglects the historical patterns of speculative fervor and eventual collapse. Galbraith highlights that government and regulatory bodies must act decisively to curb speculative excesses. Historical examples, such as the implementation of the Securities Act of 1933 and the establishment of the Securities and Exchange Commission, SEC, in response to the 1929 stock market crash, illustrate how effective regulation can restore stability. These measures brought transparency and accountability, which are crucial in preventing unchecked speculation and protecting the broader economy. The book emphasizes that regulatory frameworks should be proactive rather than reactive, designed to anticipate and diffuse potential speculative bubbles. Galbraith cautions that overconfidence in market self-regulation often preludes financial disasters. He stresses the importance of regulatory vigilance and robust financial oversight to safeguard against the cyclical nature of euphoria-driven market excesses. The practical takeaway is clear. Enduring stability in financial markets requires continuous and stringent regulatory oversight. Governments must remain vigilant, adapt to evolving financial landscapes, and enforce regulations that preemptively address the factors leading to financial euphoria. This proactive approach is paramount in preventing the severe economic and social consequences of financial crises. In A Short History of Financial Euphoria, John Kenneth Galbraith delves into the recurrent nature of speculative financial bubbles and the inevitable crises that follow. The section, Lessons from Past Financial Crises, underscores the repetitive cycle of euphoria and despair that characterizes financial markets. Galbraith emphasizes the historical tendency of investors and institutions to believe that this time is different, ignoring the lessons of past exuberances. This belief stems from a combination of greed, overconfidence, and the allure of easy riches, driving irrational investments based on inflated asset values. Central to Galbraith's analysis is the observation that financial memory is egregiously short. Each generation, convinced of its superior understanding, fails to learn from its predecessors' mistakes, leading to the repeated emergence of speculative bubbles. Examples, such as the Tulip Mania of the 1630s, the South Sea Bubble of the 18th century, and the Great Depression of 1929, illustrate the timeless nature of financial folly. A critical takeaway from Galbraith's work is the importance of skepticism and historical awareness in financial decision-making. Investors are urged to remain wary of unsubstantiated optimism and to maintain a long-term perspective. Regulatory bodies, too, must recognize their role in mitigating speculative excesses through vigilant oversight. Ultimately, Galbraith asserts that understanding the cyclical nature of financial euphoria can help mitigate its impact, fostering a more stable and resilient economic environment. This section serves as a cautionary reminder that while financial innovation and ambition drive markets, they also necessitate a grounded understanding of risk and historical precedent. In A Short History of Financial Euphoria, John Kenneth Galbraith delves into the recurrent cycles of boom and bust that characterize financial markets, elucidating the psychological and structural factors that drive these phenomena. The core concept is that financial euphoria, fueled by speculation and the collective belief in perpetual prosperity, leads to unsustainable economic booms. These booms inevitably culminate in busts as reality confronts inflated asset values and unfounded optimism. Galbraith emphasizes the role of speculative fervor in these cycles, where investors dismiss historical experience and rational constraints, entranced by the allure of quick wealth. This euphoria often manifests in financial innovations or new market opportunities perceived as unprecedented, which in turn justify reckless investment behaviors. The author illustrates this with historical examples such as the Tulip Mania of the 17th century, the South Sea Bubble, and more recent financial crises, underscoring the timelessness of these cycles. A critical takeaway from Galbraith's analysis is the recognition that both individual and institutional investors are susceptible to collective delusion. This highlights the importance of skepticism and historical awareness as defenses against the seductive nature of financial euphoria. By understanding the inherent cyclicality of markets and the psychological underpinnings of investor behavior, individuals and policymakers can better anticipate and mitigate the impact of future financial disruptions. Galbraith's exploration serves as a cautionary tale, urging vigilance and prudence in the face of seemingly boundless economic opportunity. In A Short History of Financial Euphoria, John Kenneth Galbraith meticulously dissects the recurring patterns of speculative excess that have perennially impacted society. The section on the impact of financial euphoria on society underscores how financial euphoria invariably leads to profound societal transformations, often with detrimental consequences. Galbraith identifies the core concept of speculative bubbles, driven by irrational investor exuberance, which detach asset prices from intrinsic values. This euphoria, while initially fostering economic growth and prosperity, invariably culminates in financial crises that ripple through society, exacerbating economic inequality and social unrest. Galbraith illustrates this with historical examples, such as the Dutch Tulip Mania and the stock market crash of 1929, which highlight a cyclical pattern of human folly and economic disruption. These episodes demonstrate that while financial euphoria can spur innovation and temporary economic booms, it ultimately results in severe corrections that harm investors, destabilize economies, and erode public trust in financial institutions. The book stresses the importance of recognizing these patterns to mitigate future crises. Galbraith advocates for enhanced regulatory frameworks and a more informed public discourse to curb speculative excess. He emphasizes the need for vigilance against the seductive allure of quick wealth, urging policymakers and investors to prioritize sustainable economic practices over short-term gains. The practical takeaway is clear. Understanding and learning from past episodes of financial euphoria is crucial to fostering a stable and equitable financial system that serves broader societal interests. In the contemporary examples of speculation section of A Short History of Financial Euphoria, John Kenneth Galbraith expertly dissects the recurring patterns of speculative episodes in modern financial history. The core concept revolves around the cyclic nature of speculative euphoria, where irrational exuberance fuels asset bubbles, leading to inevitable market corrections. Galbraith illustrates how each new generation, convinced of its unique wisdom and sophistication, falls prey to the timeless allure of easy wealth and ignores historical precedents. The section connects directly to the book's overarching theme by demonstrating that despite advancements in financial instruments and market structures, The fundamental psychology of speculation remains unchanged. Galbraith underscores this with contemporary examples, such as the dot-com bubble of the late 1990s and the housing market frenzy leading up to the 2008 financial crisis. These instances exemplify how speculative mania is often driven by a collective belief in new economic paradigms and technological revolutions, which eventually prove unsustainable. A critical takeaway from this section is the importance of skepticism towards claims of a new era that purportedly justifies exorbitant asset valuations. Galbraith advises investors and policymakers to maintain a historical perspective, recognizing that euphoria-driven markets inevitably face harsh corrections. By understanding these patterns, stakeholders can better anticipate and mitigate the adverse effects of speculative bubbles, thus fostering a more stable economic environment. This insight is invaluable for navigating the ever-evolving financial landscape while being mindful of the perennial nature of financial euphoria. In Preventing Future Financial Euphoria, John Kenneth Galbraith delves into the mechanisms necessary to avert the cyclical bursts of irrational financial optimism that have historically led to economic crises. Galbraith underscores the importance of historical awareness and a disciplined skepticism in financial markets as key defenses against euphoria. He argues that understanding past financial manias, from the Dutch Tulip Mania to the 1929 stock market crash, equips investors and policymakers to recognize and temper the speculative excesses that precede economic turmoil. A critical concept Galbraith emphasizes is the inherent human tendency towards speculative greed, often fueled by a collective delusion of infallibility during economic upswings. He asserts that stringent regulatory frameworks and vigilant oversight are essential to mitigate these tendencies. Examples such as the implementation of the Glass-Steagall Act post-1929 demonstrate how regulatory intervention can restore stability and confidence in financial systems. Furthermore, Galbraith stresses the necessity of cultivating a financial culture that values prudence over reckless ambition. Financial education and ethical standards should be prioritized to foster an environment where sound judgment prevails over speculative frenzy. This aligns directly with the book's overarching theme, recognizing and countering the seductive allure of financial euphoria through informed restraint. In essence, Galbraith's prescriptive analysis offers a roadmap to safeguarding economic stability, integrating historical insights, enforcing robust regulations, and promoting a culture of financial responsibility. These measures serve as bulwarks against the cyclical nature of financial euphoria, ultimately aiming to create a more resilient global economy. In the conclusion of A Short History of Financial Euphoria, John Kenneth Galbraith decisively underscores the recurring nature of speculative financial excesses and the crucial need for understanding and mitigating such phenomena. Galbraith identifies the persistent human tendency to believe in the infallibility of financial markets during periods of economic boom, which invariably leads to cycles of euphoria and subsequent collapse. He emphasizes that these speculative episodes are grounded in the collective belief in new financial instruments, misunderstood or exaggerated innovations, and a misplaced trust in the expertise of financial leaders. Galbraith illustrates these concepts through historical examples such as the tulip mania of the 17th century, the South Sea Bubble, and the stock market crash of 1929. These cases reflect the perennial pattern of speculative euphoria, where irrational exuberance overrides sound financial judgment. The book's theme, underscored in this section, is the inevitability of these cycles unless there is a conscious effort to recognize and restrain the psychological impulses that drive them. The practical takeaways from this conclusion are clear. Financial literacy and skepticism should be promoted to counteract the allure of speculative bubbles. Policymakers and investors must cultivate an awareness of historical financial patterns and the psychological factors that fuel them. By fostering an environment of informed caution and promoting regulatory frameworks that curb excessive speculation, society can mitigate the impacts of financial euphoria and protect economic stability. Galbraith's insights serve as a cautionary reminder of the perils of unchecked financial optimism and the importance of vigilance in financial markets.